Welcome back to another video. In this video, we are going to work on bulletproof psychological armor. So as an investor, it's almost more important to develop the psychology because most people's portfolios aren't the problem, they are the problem. So we're going to take another portfolio here using the Gates Foundation portfolio, and we're going to shatter more Wall Street myths and illusions that civilians fall into the trap of. So let's look at it. What we have here is an absolute fortress of a portfolio. This, when you get to a certain level of wealth, it is all about preservation and protecting the assets. This is an asset under management of around 35 billion. You know, once people get to like 100 million portfolio value, the focus becomes preservation, because it's not really an extra 50 million on a $100 million portfolio does not change the lifestyle for the investor, but losing it certainly does. So I don't like using the word diversified portfolio because that's like a sort of civilian word that a legacy financial planner loves to shout about. I like to use the word bespoke because this portfolio is a tailored portfolio, and we're going to look at it. So this is the Gates Foundation, and what we have here is all the 80% across 5 stocks, which a legacy financial planner would look at this and rip it up, and they would say to this portfolio, they're over concentrated, there is an element of risk, and this needs to all be in the S&P 500. And what's happening here is this is stock picking, and that is, heresy in the financial space because no one can beat the market. And Wall Street tell you that so they can sell you the market and charge you a 1% asset under management fee. How ironic is that? I'm going to completely change the terminology of outperforming the market. Wall Street have got it as, to outperform the market, you need to tell us what stock is going to go up tomorrow, which is impossible. But I'm going to tell you how the actual family offices, how they view outperforming the market. So what we have here in this portfolio, a massive majority: Berkshire Hathaway, Waste Management, Canadian Railway, Microsoft, Caterpillar. These are absolute fortresses. Berkshire owns, obviously, Geico Insurance. It owns an entire railway as well in itself. Obviously, an absolute fortress balance sheet, as we know. Waste Management has a complete monopoly in that sector. But no one can really infiltrate that. There is no possible way someone can compete. Again, another railway, Canadian Railway. Railways are a real, true physical moat. When we talk about moats, people think every moat is sort of equal. It's not at all. See, a weak moat is something where if the government writes it on a piece of paper, people view that as like a strong moat. But if the government wrote it on a piece of paper, the government can take it away. Look what happened to FICO. Everyone viewed that as a defensive asset, but truly it was just a bit of paper, and the next administration or anyone can change that piece of paper. So the asset is not truly a deep moat. But a railway is different. A railway cannot be changed by a government piece of paper. There's 2,000 miles of railway that is the absolute bedrock of the US economy. The US has they've capitalised more on their geography than any other country in the world because they have taken advantage of their Mississippi River and railways because they can export all their minerals out of the country faster and easier than anyone else. And that's what really backs the dollar from the beginning. The US didn't build its economy on the dollar, it built it on its infrastructure. And the railways are really like the veins of the US. You can transport on one railway locomotive what would take 500 trucks, and it's far cheaper because you only need to pay 2 people to drive the train, whereas you need 500 people to drive 500 trucks. So it's about that cheap logistics, And that infrastructure, that's why Warren Buffett purchased an entire railway outright, because he's betting on the deep economy of the USA. And of course, Caterpillar is another absolute deep infrastructure for the construction sector. And Microsoft has the best customers. They have the Fortune 500. Fortune 500 are the best customers you want. B2B is so strong because that company would rather lay off their staff before they lay off Microsoft software. So Microsoft is embedded in the biggest companies in the world, and these are the companies that have the money. So Microsoft can raise its prices, and even from a corporate perspective, even if a CFO decided, well, maybe we can switch to another software, they're putting their job at risk, and it's not even their money they're spending. They're spending the money of a Fortune 500 company. So they're just going to write the check to Microsoft rather than put themselves in a liability to try and switch to someone cheaper. It doesn't even make sense. So Microsoft, again, is just a deep moat in infrastructure. So that's what he's got his growth portfolio section of. So this is just rock solid. This is all about preservation. This is not about really growing the assets. It's just keeping them alive. Now, what people would say is this will not outperform the markets. Defensive companies cannot outperform the market. They cannot do that as much as growth. But if you can internalize what I'm about to say here, it will totally change the view of outperforming the market. I want you to imagine you owned a complete monopoly, and that monopoly, for 12 months, the stock price was flat. 0% in 12 months, the stock just didn't give you any growth. The civilian would say, I lost to inflation, I lost the S&P 500, I did not outperform the market, because they're obsessed with a nominal illusion. Look at this. Let's say the S&P 500, the nominal price for the full year, it went up 15%. So everyone's happy. The 401ks went up 15%. And everyone celebrates and says, see, look, the S&P wins again. And this monopoly over here, its price has stayed exactly the same. But the actual business free cash flow per share has went up 20% year over year. Mathematically, the monopoly has destroyed the S&P 500. The market has just not caught up yet. The cash flow has grown, the business has grown, and you are, as a shareholder, you have gotten wealthier in real terms. Right, so your free cash flow is up 20%, your shares are up intrinsically, but of course the market just doesn't catch up yet. But as the great Benjamin Graham once said, Warren Buffett's mentor, he taught him that the market is a weighing machine in the long term and a voting machine in the short term. And the fact is, the S&P 500, it went up 15%. The actual cash flow only went up, say, 5% in this example. Majority of that is done by the Mag 7. The Mag 7 has actually generating the earnings, and it's just dragging dead weight. The companies that below it that are over leveraged, that don't have pricing power, that are not generating real wealth. You see the difference? Actually, the only reason the S&P 500 went up was people just overpaid for the same asset. That's it. Central bank printed some money, S&P went up. And civilians are obsessed with nominal gains. Whereas the family offices, institutional investors, and the best investors of all time care about the actual free cash flow. There's a company growing. If you can internalize this without question, if you actually internalize it, a lot of people understand it, but they don't really internalize it. Even financial professionals don't internalize this. This will put you ahead completely, because this paranoia of, is my portfolio outperforming the market? It's an illusion, because if you wait long enough, that monopoly will get repriced. It could stay flat for 12 months. Yeah, January to December, it stays flat. And then the next year rolls around in February and the stock could just surge, 30-40% in a single month. And the stock price is catching up. This is what people need to look at. And the same applies even for big tech growth companies. Their free cash flow might not grow every year because they're spending money on making their moat deeper, building data centers, building infrastructure to make them last the next decade. But the business is still growing, the revenue is still going up, the cash flow is going up. You can't punish the stock for spending on infrastructure if it's to build the moat. So this is just something that legacy financial advisors can't say this. If they just said, well, if you actually just held monopolies and the business kept generating and growing every year despite the stock price, whatever it was doing, you're outperforming. They can't say that. It would destroy their own business. They care about their job. They don't care about protecting your wealth. They care about their own liability. That's why if they sell an index to everyone and it crashes, well, the whole market's down. So you can't fire me. I'm not liable. That's what they care about. Their own protection. What would a portfolio manager do if it was just as simple as buying monopolies and doing nothing? They wouldn't have a job. So they physically can't say this. Now, a great thing about, this portfolio is literally like solid as a rock. It's just very low beta, very low growth, really. Some of these companies will just do absolutely nothing. They are so boring. And if you don't want boring companies in the growing stage, but you would love them once you have achieved the wealth that you want and your portfolio start to drown out the growth with stability, which we can obviously see here because, obviously Bill Gates would have had a huge stake in Microsoft. I don't know what his exact percentage was, but could have been, that portfolio could easily have been 100% Microsoft. But it gets to a point where you want to start protecting your wealth, and that's why you do this. These are all anchors. These are the ballast, the stability that you only put in once you are at a point where you're ready to borrow against the stock for growth, and you're ready to do that, and you're happy with the stage you're at. But this is just an example of what the end game looks like, because the upside potential of these portfolios as well is still massive. Because if you look at Caterpillar, what happened to Caterpillar over the last year is it went up 170%. For a company that's classed really as somewhat of a defensive durable stock, that's incredible to see that sort of return. So this is why it's so important to focus on the actual companies, what the company's doing. Is it growing the actual cash flow? Because that takes away your anxiety. This gives you the psychological armor, and you start to see through the illusion of just a legacy advisor telling you to just put everything in the S&P 500 and do nothing and don't ask any questions. Because, well, why is this portfolio not just the index if that was the answer? You see, we're playing a different game entirely. So that is your psychological armor on your actual assets. Just look at the assets. If you're ever feeling the stock price is going down, you can just go onto any platform and just have a look and see, is the revenue growing? Is the cash growing? Are these numbers going up? And are they buying back shares? This is why we love buybacks. We love buybacks because there's no taxes. I would personally rather a low dividend and lots of buybacks and get the capital growth, because dividends equals taxes. Of course, depends on everyone. If you're a low tax bracket, dividends are fantastic, but it's all about your personal preferences. But there you go. That's the psychological armor to totally change your view on outperforming the market. So if your assets have grown, the cash flow has grown, the share prices is stayed flat, Don't let that cause you any anxiety. The company is still compounding. This is what Berkshire Hathaway was built on, this philosophy. And the greatest investors preach it time and time again.